Should you buy stocks of companies that are unprofitable? We're going to find out. We're going to go over the differences and analyzing the fundamentals of unprofitable versus profitable companies. Also, we're going to go over a new stock I'm buying. Is it profitable? Is it unprofitable? Maybe it's a stock you might want to invest in. We're going to go through the fundamentals of this company at the end of the video. Stick around if you enjoyed this content. Please like, subscribe, comment if you have any questions. This is a small channel and I respond to every single comment. So any questions, feel free to comment below. Let's get into it. The most obvious issue with investing in companies that are unprofitable is that those companies have to rely on outside investment to keep the business afloat. So if investment takes a turn for the worse and if revenues take a turn for the worse, and the company starts bleeding cash flow, the only thing they have left to do is file bankruptcy! The other issue we run into is there's not as much data on how to value the company if they're unprofitable. A lot of times unprofitable companies have short lifespans on the stock market. They may not have been around very long. Also, if it's unprofitable, we can't look at PE ratios. Now, we can look at forward PE ratios if the company is projected to become profitable within the upcoming year. So let's take a look at a company that's unprofitable right now. We're going to look at Rigetti, which is kind of a popular stock in that they're in quantum computing, but they're unprofitable, and we're going to look at their stock, analyze the fundamentals. Okay, so we can see here we've got Rigetti pulled up on Yahoo Finance right now, and I just kind of want to show you right now we're blank for trailing PE, which is the normal PE that I like to look at, and we're also blank for forward PE. So Rigetti is not projected to be profitable in the upcoming year. So we're in macro trends now. Let's check out, we'll just look at their revenue. Okay, so trailing 12 months, revenue has slowly been increasing, so that doesn't look too bad. This is just going back to the 2020, end of 2021. So we've got about 3 years or so of data here. And, you know, we saw a climb and we've seen a little bit of a digression here, but not too bad with revenue. Let's look at net income. Obviously, net income is going to be to the negative, but I do like to see a net income that is trending upward. So we're kind of, I mean, when you look at this, I really want to see this bar the lowest of everything. I want to see, I mean, obviously we're getting worse here for a while. Now we're slowly getting better, but this is still kind of not where I would like to see it. I really want to see more of a up and to the right. And this is kind of almost a pyramid, and just not the best, but it's not horrendous. Let's look at their financials. We can look at their balance sheet, cash on hand. So cash on hand has been kind of decreasing since the beginning here. I don't really like to see that. Obviously, for a company that's unprofitable, they're going to have more exposure and risk into using the cash they have on hand. Looking at their balance sheet, we have 159 million in total assets, and we have 50 million in total liabilities. This is a pretty good ratio. I mean, this is about triple the assets to liabilities. I like to see that. Also, they have enough cash on hand to well over cover their total liabilities. So all in all, for a balance sheet, they've got a great balance sheet. If we look at the income statement, obviously we don't have a ton of data here because they've only been publicly traded for a few years here. Obviously we had 8 million in 2021. We had over a 50% increase into 2022, but as you can see, moving into 2023, we had a decrease, and we definitely do not want to see that with an unprofitable company, because we're really taking a risk with an unprofitable company that's not having impressive revenue growth year over year, because this is just not to say that they can't recover from this, but the risk we already have with an unprofitable company, I want to see these numbers. If I'm buying the stock, I want to see these numbers increasing at a rapid rate, because we need high growth numbers for a company if it's unprofitable, just to make sure that we're investing in something that's got a lot of upside potential. So if we come over here to Yahoo Finance, obviously we have the trailing 12 month on Yahoo Finance. We did not have that on Macro Trends. And even going into here, we've got more like a higher decrease, which we got one more quarter before we'll have a total year. And, it's not looking good. I really would want to see this number over trailing 12 months higher than the previous year. So for me, there's just too much risk with Rigetti right now. I'm not liking what I'm seeing. Obviously, with price ratios, we're not going to have a PE ratio. So obviously for me, Rigetti is not a buy. There's just too much risk involved. But I do want to talk about, why would we choose to buy an unprofitable stock versus just buying profitable stocks? A lot of investors really don't buy unprofitable stocks and only focus on the profitable ones. The biggest upside we have for unprofitable companies is that there can be potentially a ton of upside if you invest in them before they get into profitability.
All right.
But because there's more risk involved, we really want to keep these positions smaller than the rest of the positions in our portfolio, just in case. And we really want to see a clear picture of what future profitability is going to look like. So we want all the numbers to be excellent. And for me, I want to see a company that's expected to become profitable in the following 12 months. So what stock am I buying? I'm buying Okta. It is unprofitable, but it is expected to be profitable in 2025. Let's check it out. Okay, so here we are, Okta's webpage. Okta's a cybersecurity company, which is an arena or space that I see growing in years to come. It's expected to grow as we move further into the digital age and the internet age. Internet security is very important, and we've seen tons of breaches in the past with different security companies. So cybersecurity is more important than ever, obviously. Now, they do have competition. Obviously, Google and other companies like that, they offer solutions for cybersecurity. So Okta does have some competition. But what I really like about it is the fact that it does have some big partners. We have FedEx down here, Wyndham Resorts. So they do have some big clients, and their retention rate is pretty good. They also have an expanding line of products that they use. And the great thing about that is, when you have multiple products for a consumer to use, the more products they use that are yours, the more likely they are to stay with you. We see this in companies like Apple. So we use the iPhone, we use iPad. And once you start using Apple products, the fact that you use more than one makes it worth the cost, even if you pay more to use Apple than another company, because all these things you use in your daily life. So you're that much less likely to move on to somebody else. So Okta's also building out their product platforms, adding on more products, and let's check out their fundamentals. Okay, so we're over here on Yahoo Finance, and we're under statistics. And as we can see down here, there's no trailing PE because the company has not been profitable, but we have a forward PE. And in the past few quarters, we see that it was up here around 40, 41, in the 40s, and it's come down. And now we're sitting around the high 20s, which is good. High 20s is, a good range for a company that's got a lot of growth ahead of it. I really prefer to stay under 30 if possible when I'm investing in a company. But also, you've heard me talk about, I will go up into around 50. For instance, Nvidia right now is if it happens to get under 50, there's a good chance that I might pick up some shares if I have money available to buy them with. Okay, let's come over to Macro Trends and let's check out revenue for Okta. We got a great revenue chart here, up and to the right. exactly what I want to be seeing. I want to be seeing growing revenue. And let's move over to net income. Okay, so we look at trailing 12 months. We're still in the negative, but we have a great uptrend right here. Obviously, we had a bit of a pyramid. So if we were right here, I wouldn't be too happy. I would not be buying it if we were kind of showing these numbers here. But with this long increase moved here, we're about to flip into profitability, at least with trailing 12 months. If we come down to quarterly, the past 2 quarters have been positive net income as far as the quarters go. So that's fantastic. That's really what I like to be seeing, is that we're getting into profitability here, and pretty soon we'll have a full year of profitability if this continues. Okay, so let's look at the financials. We're going to check out the balance sheet, and let's look at the cash on hand. All right, so we have increasing cash on hand. Obviously, we've been kind of at a plateau here for a while. A small decrease, but overall a decent graph. They're pretty much keeping their cash on hand, and it looks like they kind of hit a downturn, but we're starting to kind of pick back up those numbers. We're going to go back to the balance sheet, look at the rest of it. All right, total assets. We have almost 9 billion, and we have just over 3 billion of total liabilities. So a fantastic ratio. It's almost a 3 times ratio. Cash on hand is decent. We have 2.2 billion of cash on hand. Now, this balance sheet isn't as good as the Rigetti, but with the rest of the information we have, this is still a great balance sheet. The only thing that can make this better was if the cash on hand completely covered the total liabilities, but it does cover most, over half. I'm happy with that, and I'm happy with the ratio of assets to liabilities. So let's check out the income statement, and just looking at revenue growth. We have 399 million, and moving into 2020, we had a good 25 to 30% increase. We had another, what's probably 30 to 40% increase going into 2021, big increase into 2022, almost 50% increase around to 2023, and now not as big of an increase going into 2024. We're still in good revenue growth, especially with the net income slowly moving into profitability. All that's looking great. So price ratios, obviously, we're not going to have any P ratio down here. So what we can do is look at price to sales, and we see pretty good price of sales here, because right now where we're at versus where we have been, obviously over here back in 2018 we were at 8.2 going up to 14, and now we are sitting below 6. So we're at a low price of sales ratio, and we've got great increasing revenue, we've got increasing net income, we've got a good balance sheet. All the fundamentals are looking really good, and I'm seeing this company as just a good long-term play. I think they probably will come into a full year of profitability in the next couple quarters. We'll see how it goes, but I feel like this company's got great potential upside, and I think the price is fantastic on it. I hope you guys found this video informative. If you liked it, please like and subscribe. I've got a video that I will share right now that is my 5-point checklist on how to find safe companies with plenty of upside. And leave a comment. I'll respond. Y'all have a great day.